So if we go back to 2022, the Japanese yen just absolutely collapsed. I mean, it was a historic, brutal bloodbath.
Oh, yeah. Completely unprecedented.
Right. And if you were, sitting in an office in New York or London and you're just looking at the currency boards on a Bloomberg terminal, you honestly would have thought the entire nation of Japan was actively sinking into the ocean
Right.
because the charts just looked like a catastrophic societal failure. But, and here's the wild part, if you actually walked the streets of Tokyo that same exact week,
It was perfectly normal.
things were actually completely fine. I mean, the trains were running to the absolute second. Restaurants were packed. Unemployment was hovering near this like microscopic 2.5%. And the country was still exporting just mountains of high-tech goods.
Yeah, the physical reality was totally fine.
Exactly. The dashboard was flashing red. The alarm bells were just deafening. But the actual engine of the country was purring along perfectly. And so the question is, why? Well, because the dashboard of the global economy is just entirely broken.
Well, I mean, I would actually argue it's worse than broken, right? We're basically measuring the wrong vehicle altogether at this point,
Right.
because we're all still operating under this deeply ingrained mid-century assumption, this old gold standard of economic logic that essentially told us that a strong currency was the market's way of giving a country a standing ovation.
Like a report card.
Exactly, a scorecard. We were all taught that, if you see the value of a nation's money surging, it meant they had stable institutions, highly productive workers, and they were manufacturing physical things that the rest of the world desperately wanted to buy. It was a scorecard for good economic behavior. But honestly, that framework is just dead.
And that right there is the core thesis of our deep dive today. We are essentially ripping up the old dashboard for you all. The reality we're unpacking for you today is that currency strength is largely an illusion now.
A total illusion.
Right. It is no longer this reliable mirror of domestic economic health. Instead, it's just a reflection of the massive, relentless, and honestly sometimes completely irrational movement of global capital.
Yeah, that's spot on.
So we're going to explore exactly what drives the price of money today, how financial engineering can completely mask actual economic rot, and why understanding, quote-unquote, capital flows is really the ultimate cheat code to being truly well-informed about the global economy. So, okay, let's unpack this, because how did we go from a world where selling actual goods made your money strong to a world where currencies are basically divorced from physical reality?
Well, to really understand that disconnect, you have to look at the sheer scale of the plumbing. So historically, let's say during the post-World War II Bretton Woods era, exchange rates were almost entirely driven by actual physical trade balances.
Okay, so it's physical.
Very physical. So, for example, if West Germany exported a massive volume of cars or, industrial machinery to the United States, those American buyers physically needed to acquire Deutschmarks to pay for those goods.
Right, you can't buy a German car with dollars in Germany.
Exactly. And so that commercial demand for the German currency naturally drove its value up. The currency was strong because the country was physically producing value. But today, if you look at the global foreign exchange markets, the FX markets, they process over $7.5 trillion every single day.
I mean, wait, 7.5 trillion daily. I'm trying to wrap my head around that scale. That
Yeah.
means the FX market trades the entire annual GDP of the United Kingdom before, like, lunch.
Yeah, before your morning coffee gets cold, honestly.
Ah.
And here is the mechanism behind that just mind-bending number, right? Only a tiny, almost microscopic fraction of that 7.5 trillion has literally anything to do with physical trade anymore.
So it's not people buying cars.
No, not at all. The vast majority of those dollars and euros and yen changing hands, they have absolutely nothing to do with someone buying a Toyota or, importing wheat or paying for a software license. It is purely financial flow. So capital, not goods, is what now sets the price of money.
Okay, so it used to be like a company's stock rising because they built a great new product, everyone bought it, their revenue went up, and the stock naturally followed. But now it's more like the stock is rising just because a massive herd of day traders decided to park billions of dollars in that specific ticker symbol for the afternoon,
Yes.
completely ignoring whether the company even makes a viable product anymore.
Yeah, let's actually push that day trader analogy even further because it's perfect. Imagine those day traders aren't just using their own cash, right?
Wow.
They are using, say, 100-to-1 leverage that they borrowed from algorithmic prime brokers.
Oh, wow. Okay.
And they don't care about the company's long-term business model. They don't care about the management team. They literally only care about the immediate financial incentives of parking their capital there right now and riding the momentum of the crowd. And because there are just so many of these participants moving such staggering amounts of leveraged money, their sheer weight dictates the price. The tail is just violently wagging the dog at this point.
Right. Okay. But money doesn't just move for the fun of it, right? It's always hunting for something. If I'm looking at this ocean of capital sloshing across borders, it's obviously not all the same kind of water. So let's deconstruct these flows a bit. What are the actual flavors of capital that we are talking about here?
Sure. So the flows basically sit on a spectrum of speed and intent.
Hmm.
At the most stable end of the spectrum, you have what's called foreign direct investment, or FDI.
Okay.
And this is the long-term fundamental commitment. Think of a massive multinational corporation deciding to build a $5 billion semiconductor manufacturing plant in a foreign country.
Right. A physical thing.
Exactly. That takes years to plan, years to build, and you obviously cannot easily pack up a physical foundry and move it across the border if the currency markets get a little jittery on a Tuesday. So that is incredibly sticky capital.
Which makes total sense because it's tethered to the actual physical reality of a place. But I imagine the volume of people building semiconductor plants probably pales in comparison to the people just buying digital assets, right?
Oh, radically so. Which brings us to the next flavor, which is portfolio flows. And this is capital moving into foreign stock markets and bond markets.
Okay, so much faster than a factory.
Far more liquid. Institutional investors are moving this money across borders, mainly chasing yield, and they're reacting to macroeconomic data releases. They can sell those bonds with the click of a mouse, sure, but it is still fundamentally tied to the idea of investing in a country's corporate or sovereign output.
Right. But I'm waiting for the dangerous one because where do those highly leveraged day traders fit into this picture?
Ah, yeah, that would be the third flavor, hot money.
Hot money.
Yes, and this is short-term, highly speculative flow. It absolutely does not care about underlying economic fundamentals. It doesn't care about youth employment or industrial output or anything like that. It is solely chasing momentum, exploiting tiny transient interest rate differentials, and it moves at literal lightning speed. It's algorithmic, it's highly aggressive, and it can reverse direction in milliseconds.
Wait, okay. If hot money is just this destructive, transient force that can completely destabilize your country's currency in literally milliseconds, why do governments even allow it?
Oh, wow.
I mean, why not just pass a law banning short-term speculative capital flows and only accept the long-term factory builders? It seems like they're actively choosing to leave the front door unlocked for arsonists.
That's a great question. But the brutal reality is that almost no modern economy can actually survive solely on its own domestic savings. Most developed nations run massive structural deficits. They spend way more than they take in through taxes.
Oh, right. So they need the cash.
Exactly. To fund that gap, they have to issue government bonds. If they ban hot money or if they heavily restrict capital flows, they choke off the massive pool of global liquidity that they desperately need to buy that debt. So they leave the door unlocked because they literally need the arsonists' cash to pay the mortgage.
Wow. Okay, that's stark, but it makes perfect sense.
And sitting above all of this, by the way, is the fourth category, which is official flows. This is central banks and sovereign wealth funds.
The whales.
The ultimate whales.
Yeah.
When a sovereign wealth fund decides to, say, reallocate $1 trillion of energy profits from U.S. treasuries over to European bonds, they move capital in such sheer massive bulk that they permanently alter the baseline gravity of a currency pair.
Okay, so we've got the factory builders, the bond buyers, the momentum chasers, and then the central bank whales. But what is the overarching force that dictates how aggressive or defensive all these players are at any given moment? Like, what's the weather system here?
The weather system is global liquidity, period. Think of global liquidity as the total volume and the cost of money available in the financial system. When major central banks, and specifically we're really talking about the U.S. Federal Reserve here, when they expand liquidity by printing money and lowering interest rates down to zero, money becomes abundant and cheap.
Right.
And abundant money gets incredibly aggressive. It actively hunts for returns across the globe. It pours into riskier assets, emerging markets, speculative trades.
And when the Fed pulls back, like when they raise rates and shrink the money supply,
The capital violently retreats. It abandons all those risky bets in emerging markets and floods right back to the perceived safety of the core. So the central banks basically shape the exact cost and availability of this money, which means a country's currency might suddenly shoot up in value, not because that country reformed its tax code or invented some amazing new technology, but simply because the global liquidity cycle shifted. The music changed, and the capital just needed a new place to park.
Let's get into the actual mechanics of this because I want you, the listener, to understand exactly how this illusion is manufactured in the actual plumbing of the system. Let's talk about the carry trade. You hear this term constantly in financial media, but it's really rarely explained in plain English.
Sure. Let me take you right into the plumbing. A carry trade is really the purest distillation of what we call yield attraction. Let's look at the Japanese yen, which has been the quintessential funding currency for decades now.
Okay.
For a very long time, the Bank of Japan kept their interest rates at zero, or sometimes even below zero, just to fight off deflation.
Okay, so let's play this out. I'm a macro hedge fund manager in New York. How do I actually exploit that 0% rate? What's my literal first step?
Well, your first step is you go to a massive prime broker and you borrow, say, 10 billion Japanese yen. Because the interest rate in Japan is effectively zero, borrowing that absolute mountain of money costs you almost nothing in interest payments.
Right, free money.
Essentially, yes. Now, you look across the globe and you see that the United States Federal Reserve has raised interest rates to, let's say, 5%.
Okay, so I take my 10 billion borrowed yen, I sell them in the FX market to buy US dollars, and then I use those dollars to buy US Treasury bonds that are yielding 5%.
Precisely.
So I pay zero on the loan, I earn 5% on the bond, and I just pocket the entire spread.
Exactly.
Yeah.
And because you are a hedge fund, you obviously don't just do it with your own money. You leverage it. You might lever that specific trade 10 or 20 times over. Now, I want you to multiply your single trade by thousands of other hedge funds, institutional asset managers, and massive algorithmic trading desks who are all doing the exact same thing simultaneously.
Oh, wow.
They're all relentlessly selling the Japanese yen and indiscriminately buying the US dollar.
And all that immense selling pressure just crushes the yen, while all that intense buying pressure forces the value of the US dollar to skyrocket.
Yes. And if you were looking at a traditional economic dashboard, you'd look at that chart and say, wow, the U.S. economy must be performing light years ahead of Japan. Look at the incredible strength of the dollar.
Right.
But the underlying domestic economies haven't changed at all in that moment. The dollar is incredibly strong, purely because it is the target of a mechanical financial operation. It is an illusion of strength that is conditional entirely on that yield gap remaining open.
Okay, I totally buy that yield drives currencies artificially higher. That makes mathematical sense. But what about sheer unadulterated fear? Like if the global economy is melting down, does that change the math?
Completely. That introduces what we call the safe haven paradox. In times of extreme global panic, say, a massive pandemic, the outbreak of a major war, or a systemic banking crisis, capital stops looking for growth.
It doesn't care about the 5% anymore.
No, it completely stops caring about the 5% yield of a carry trade. It just wants to survive. So it flows entirely into currencies perceived as structurally secure. Primarily the US dollar, the Swiss franc, and sometimes gold.
So if I'm understanding this correctly, during a massive global crisis, a country's domestic economy could be actively suffering. Like businesses are shuttering, unemployment is spiking, supply chains are totally broken. But its currency shoots through the roof simply because terrified foreign investors just need a mattress to stuff their cash under.
That is exactly the paradox. The currency appreciation in a safe haven country during a crisis is not a sign of domestic resilience at all. It is literally a heat map of global terror. The worse the world gets, the stronger the safe haven currency appears.
Man. Okay, so we have yield attraction and we have sheer panic. But what about the stock market? I mean, if the U.S. tech sector is absolutely booming and everyone on Earth wants a piece of Apple, NVIDIA, and Microsoft, doesn't that stock market frenzy create its own gravity for the currency?
Oh, it creates a massive gravitational pull.
Yeah.
We call that the asset market magnet effect. If a country's stock market is wildly outperforming the rest of the world, foreign investors naturally wanted to participate, right? But a German pension fund cannot just buy shares of Microsoft with euros.
Right. The exchange has to happen.
They must first convert their euros into US dollars to actually execute the trade on the NASDAQ.
So the sheer act of buying the stock inherently forces them to buy the currency, which pushes the dollar higher.
Exactly. And that initiates a highly dangerous self-reinforcing feedback loop. The rising asset prices attract the foreign capital. The incoming capital then pushes the currency higher. Now, put yourself in the shoes of that foreign investor. Not only are the tech stocks you bought going up, say, 20%, but the US dollar you hold them in has also appreciated by 5%, against your home currency.
So your returns are supercharged.
Magnified, yeah. Which makes the investment look like an absolute guaranteed winner, which then draws even more foreign capital in. It's a closed-loop system. The stock market and the currency are just endlessly propping each other up based on pure momentum.
Meanwhile, the actual real-world economy, like, the small businesses in Ohio or the manufacturing sector in Michigan, might be completely stagnant or even actively in a recession.
Precisely. And this mechanical detachment leads us to these real-world paradoxes that really define modern macroeconomics. These are scenarios where the economic scorecard and the currency value are telling two completely hostile stories. Let's look at the strong currency, weak economy paradox first.
Yeah, I feel like we see this all the time. Can you give me a concrete historical example of how a currency can look like this impenetrable fortress while the actual economy is rotting from the inside?
Sure. Look at the early 1980s in the United
Yeah.
States, under Federal Reserve Chairman Paul Volcker. Or honestly, even more recently with the U.S. dollar in late 2022. The domestic economy might be facing severe headwinds, right?
Mhm.
High inflation, slowing growth, perhaps even a technical recession. But to fight off that inflation, the central bank jacks interest rates up aggressively.
Which instantly triggers the exact carry trade mechanics we just outlined.
Yes, those sky-high interest rates act as a massive electromagnet for all that global hot money. Capital just floods in, chasing the high yield, and so the currency stays incredibly strong. To an outside observer who's only looking at the FX ticker, the country looks invincible. But it is financial engineering acting as a smokescreen.
Wow.
In fact, the strong currency makes the country's exports incredibly expensive and uncompetitive globally, which actually suffocates their manufacturing base and harms the real economy even further.
So the central bank is basically pulling off a magic trick. They use high rates to manufacture a strong currency, which hides the structural damage from the global markets, while simultaneously crushing the local factory worker who can no longer sell their goods abroad because they're too expensive.
Exactly.
Well, what about the inverse? How does a booming economy end up with a garbage currency?
Right, so for the weak currency, strong economy paradox, we have to look at the 1990s Asian financial crisis. In the mid-90s, countries like Thailand and South Korea were the, quote, Asian tigers. They were doing seemingly everything right on the physical level. They were building massive infrastructure, youth employment was booming, their GDP growth was in the high single digits. I mean, they were economic powerhouses in the making.
So their dashboard should have been flashing green across the board.
It was, and that attracted a absolute tsunami of foreign hot money. But, and here's the catch, much of that capital didn't go into long-term factories. It went into speculative real estate and short-term corporate debt, often denominated in U.S. dollars. And then the global liquidity environment shifted. The U.S. Federal Reserve started raising rates, and the U.S. dollar began to strengthen.
So the yield gap closed, and the global risk sentiment just shifted.
Almost instantly. The foreign hot money realized that these Asian countries might not have enough dollar reserves to maintain their currency pegs. And the hot money didn't politely pack its bags over a few months. It fled overnight. The capital violently reversed course.
Leaving the actual physical factories completely untouched, but completely draining the financial plumbing.
Exactly. The Thai baht and the South Korean won just collapsed. The exchange rate drastically understated the actual physical strength of those nations. They still had the factories, they still had the highly skilled labor force, but their currencies looked like a disaster zone simply because short-term global risk dynamics caused a sudden stop in capital flows.
Whenever we discuss these massive global flows, all roads seem to eventually lead back to the United States. It feels like the U.S. has persistent, massive trade deficits, a national debt that is mathematically terrifying, and constant political gridlock. Yet, whenever the world panics, the dollar gets stronger. We were talking earlier about safe havens, but this feels even bigger than that.
It is much bigger. This is what we call the dollar milkshake theory, which is a concept popularized by a macro strategist named Brent Johnson. It really explains the dollar's exorbitant privilege. The U.S. dollar is not just a regular currency. It is the fundamental plumbing of the global financial system. The vast majority of international trade, even between two non-U.S. countries, is settled in dollars.
Correct.
Global commodities like oil are priced in dollars. But most importantly, a staggering amount of global corporate and sovereign debt is issued in U.S. dollars.
Wait, okay, hold on. Why would a corporation in Brazil, for example, issue debt in U.S. dollars instead of Brazilian reals?
Because the pool of investors willing to buy dollar-denominated debt is exponentially larger, and the interest rates are historically much lower. But it creates a structural trap. When that Brazilian corporation needs to pay back the interest on that debt, They cannot print U.S. dollars. They have to earn them or they had to buy them in the open market.
Which creates a permanent underlying baseline demand for the dollar.
Yes. The world has created massive amounts of dollar-denominated debt, but only the U.S. Federal Reserve can actually print dollars. So when global liquidity dries up and a crisis hits, the entire world scrambles to find dollars to service their debts. The U.S. dollar acts like a giant milkshake straw, just sucking up the world's capital.
Oh, that's a great visual.
Right. When uncertainty rises, global institutions do not ask, is the U.S. debt to GDP ratio healthy? They literally ask, do I have enough dollar liquidity to avoid defaulting on my bonds tomorrow morning?
So people don't buy dollars because they think the U.S. economy is flawless. They buy dollars because they literally have no other choice if they want to participate in the global financial system. But this entire system, this flow-driven strength, it seems terrifyingly fragile. If a central bank keeps rates high to attract all this capital, isn't there a breaking point?
There is, and it is honestly the most dangerous event in macroeconomics. We call it the reversal. Central banks are walking a tightrope. They raise rates to pull foreign money in, fight inflation, and prop up the currency. But high rates are extremely toxic to a domestic economy. Mortgages become completely unaffordable, small businesses cannot get loans to make payroll, and consumer spending eventually crashes. Eventually, the underlying rot becomes too obvious for the global markets to ignore.
And when that realization hits, the hot money doesn't just slowly walk out the door.
Consider the alternative. If you are a hedge fund manager and you realize the trade is turning against you, do you wait for confirmation? No, you try to beat the crowd. Let's look at a historical masterclass in forced reversals. George Soros breaking the Bank of England in 1992 on what became known as Black Wednesday.
Okay, yeah, this is a legendary trade. Set the stage for us. What was the exact setup there?
Well, the UK was part of the European Exchange Rate Mechanism, the ERM. They had essentially pegged the value of the British pound to the German Deutsche Mark. But Germany was raising interest rates heavily to fight inflation post-reunification, while the UK economy was deep in a recession and they desperately needed low interest rates to stimulate growth.
So the UK was trying to maintain an artificially strong currency to honor this European agreement, even though their own domestic economy was basically bleeding out.
Exactly. And the Bank of England was trying to defy gravity. They were using their own foreign currency reserves to aggressively buy their own pounds in the open market just to keep the price up artificially. Soros and some other macro speculators looked at the math. They realized the Bank of England simply did not have enough foreign reserves to keep buying forever.
So what did Soros actually do?
He aggressively shorted the pound. He borrowed billions of pounds and sold them in the market, betting that the Bank of England would eventually run out of bullets and the currency would collapse. He forced the reversal. And because modern trades are highly crowded, meaning everyone uses the same data and sees the exact same vulnerabilities, once Soros started, the entire market just piled in.
I'm trying to visualize a crowded trade unwinding today. People always use that cliche of a crowded exit in a burning theater. But honestly, that feels too slow for what we're talking about.
Yeah, think of it more like a million people trying to use the same Uber app in a stadium parking lot. The exact second a massive concert ends. Except, instead of surge pricing going up, the value of the currency instantly gaps to zero. The algorithms all flash the sell signal at the exact same millisecond.
And when everyone hits sell at the exact same millisecond, there is literally no one on the other side of the trade willing to buy.
The liquidity completely vanishes. A currency could lose 20% of its purchasing power in a matter of hours, which obviously devastates a nation's ability to import food or energy. It amplifies what should be a necessary economic adjustment into a violent systemic crash.
Which is terrifying, really, because it implies the nation's stability isn't actually in the hands of its citizens, its workers, or even its elected officials. It is entirely at the mercy of sudden violent shifts in global risk sentiment. But the thing is, it's not just central bankers and hedge funds pulling these levers anymore. Global politics are actively weaponizing these exact flows.
Oh, absolutely. Geopolitics has fundamentally altered the landscape of currency markets over the last few years. We have really entered the era of geopolitical capital flight. In the past, capital largely moved based on math, right? Yield differentials, inflation data, growth projections. Today, a war breaks out, a new round of severe economic sanctions is announced, and the math goes completely out the window.
Because what good is a 5% yield if you think the host government is about to literally freeze your bank accounts or seize your assets?
Precisely. And we saw this vividly with the sanctions against Russia in 2022. Hundreds of billions of dollars in foreign exchange reserves were frozen literally overnight. That sent a massive shockwave through the entire global south. Money flees to perceive safety at the speed of light, causing immediate currency spikes or crashes that are completely divorced from a country's actual GDP. Fundamentals just cease to matter in the face of geopolitical terror.
And what about the physical constraints of geopolitics? Like, we saw energy markets absolutely melt down recently. How does a massive spike in oil or natural gas prices physically disrupt these capital flows?
Well, commodities, specifically energy channels, are massive, non-discretionary disruptors. Think about the mechanics. When the price of oil skyrockets due to a geopolitical conflict or a sudden supply shock, energy importing countries like Japan or much of Europe suddenly have to spend billions of extra dollars simply to keep the lights on and the factories running.
Right, they can't just choose not to buy energy. It's a completely inelastic demand.
Right, and this forces a massive mandatory reallocation of global capital. Billions of dollars aggressively flow out of energy importers and straight into resource-rich nations like Saudi Arabia, Norway, or the United States. And the currencies of those energy exporters strengthen dramatically, almost overnight.
But there is a secondary effect to that, isn't there? Because if Europe is suddenly paying twice as much for energy, that means their inflation is spiking.
Yes, the energy shock exports inflation to everyone else. This forces central banks in those importing nations to aggressively raise interest rates to fight the new inflation, which obviously alters the yield differentials, which then triggers massive new waves of carry trades and hot money flows.
It's all connected.
It is a chaotic, interconnected domino effect, where a pipeline explosion in one hemisphere triggers a mortgage crisis in another.
And adding to all this chaos is the fact that currencies aren't even really treated as money anymore. They are essentially financialized products. I want to dig into the passive flow aspect of this because I think this is where the illusion becomes truly dystopian. With the rise of massive index funds and passive ETFs over the last decade, is it true that computer algorithms are just blindly buying up currencies?
That is probably the most profound structural distortion in the modern market today. Passive investing has introduced vast, mechanical, completely blind capital flows. Let's say a committee at a major financial institution decides to add a specific emerging market country to their flagship global bond index.
Okay, so a committee just updates a spreadsheet. What actually happens next?
Well, every single passive ETF and mutual fund in the world that tracks that specific index is now legally mandated to buy that country's bonds to match the new index weighting. They do not do fundamental analysis. They do not care if the country's debt-to-GDP ratio is terrible.
Yeah.
They do not care if the government is deeply corrupt.
So essentially, the global economy is being steered by a spreadsheet error waiting to happen. A committee hits refresh on an index, the algorithm blindly buys billions of dollars of bonds, which means prime brokers are forced to blindly buy billions of dollars of that local currency, driving the exchange rate through the roof.
Yep.
And somewhere, a country's entire middle class loses their export competitiveness just because of a math equation in New York. That's not economics, that's a Black Mirror episode.
It is entirely mechanical. When a prime broker executes that order, the algorithm isn't looking for a good price. It is executing at the volume-weighted average price, or VWAP. It simply hits the order book, buying up all available currency indiscriminately until the required quota is filled. When you combine these blind, massive mechanical flows with the leverage used by speculative funds, you get a system that amplifies every little movement into a potential shockwave.
So if the system has become this mechanical, this highly leveraged, and just this completely detached from traditional textbook economics, if I'm you, the listener, trying to figure out why my vacation to Europe suddenly costs 20% more this summer, you're saying I shouldn't be looking at European tourism rates or hotel occupancy. I should be looking at whether some algorithmic hedge fund in New York decided to unwind a massive leveraged currency swap.
Unfortunately, yes. You have to completely throw away the old map, because it only shows a tiny fraction of the territory now. We need a fundamental rethinking of how we analyze the global economy. Traditional indicators like GDP growth, trade deficits, and manufacturing output, they must take a back seat to what macro strategists call flow awareness.
Flow awareness, let's make that actionable for everyone. If the old dashboard is broken, what dials are actually on the new dashboard?
First, you watch interest rate differentials like a hawk. You are not asking if an economy is quote-unquote good. You are asking who offers the highest risk-adjusted yield. Second, you monitor global liquidity conditions. Is the U.S. Federal Reserve expanding the pool of money or shrinking it? Third, and perhaps most importantly, you have to look at market positioning.
Meaning you have to know where the herd is standing.
Exactly. You have to know if trades are too crowded, If 90% of speculators are heavily long the US dollar, the risk of a violent reversal is massive, completely, regardless of what the underlying economic data says. Part of this new playbook is learning to identify flow regimes.
Markets operate in different weather systems.
Yes. Sometimes risk appetite drives everything. Investors are feeling brave, liquidity is high, and hot money dictates the flows, pushing emerging market currencies up. But sometimes the regime is dominated by pure, terror-driven safe haven seeming. The key to surviving this environment is identifying which regime we are currently operating in, and not fighting the prevailing current based on outdated textbook logic.
So we have to completely change the questions we ask. We have to stop asking if a currency is fundamentally strong and start asking why the massive wave of capital is parking there in the first place, and more importantly, when its parking meter is scheduled to expire.
Exactly. Do not look for inherent strength. Look for the motivations of the capital. And the listener needs to be prepared for the fact that these dynamics are about to get exponentially more volatile. As we look to the horizon, the global financial system is currently undergoing a massive tectonic shift toward a multipolar setup.
Meaning the unipolar dominance of the US dollar, the giant milkshake straw, won't be the only game in town forever.
Right. Nations, particularly in the Global South and the BRICS coalition, are actively diversifying away from single currency dominance to avoid the exact geopolitical weaponization we discussed earlier. We are seeing bilateral trade agreements settled in local currencies or Chinese yuan, completely bypassing the dollar network. As this multipolar system fractures the plumbing, capital flows will move in entirely new, unpredictable, and likely highly volatile patterns.
And I imagine technology is going to pour pure, unadulterated gasoline on that volatility.
Oh, without a doubt. The impending rise of central bank digital currencies, or CBDCs, along with the broader integration of blockchain technology, will create an era of hyper-digital mobility.
Wow.
We're talking about capital that can move across sovereign borders instantly, with near zero friction, settling in milliseconds, 24 hours a day, 7 days a week, without relying on traditional correspondent banking hours.
Wait, if highly leveraged hot money can already reverse course in a millisecond and crash a currency today using the clunky legacy banking system, what happens when all money can move that fast, seamlessly, and instantly?
It leads to an era of unprecedented systemic fragility. As capital becomes truly frictionless, the traditional relationships between domestic economies and their sovereign money will continue to break down. We are likely heading into a future where cross-border flow dynamics completely overpower local economic policy on a daily basis.
Okay, we have covered an immense amount of ground today, from the Bretton Woods era all the way to algorithmic index funds and digital currencies. Let's distill this into the ultimate takeaway for the listener. The core truth we've uncovered is this. Currency strength, exactly as we were all taught to understand it in high school economics, is a mirage.
Completely.
When you see a currency rising on a ticker, it is not a gold medal being awarded for a flawless society, a booming manufacturing sector, or brilliant political leadership. It is simply a heat map. It is a live tracking device showing where the massive leveraged ocean of global capital happens to be frantically flowing at this exact fleeting second in time.
It is a heat map of yield incentives, geopolitical fear, and central bank liquidity. Recognizing that illusion and understanding the plumbing beneath it is really the first vital step to truly comprehending the modern global economy.
Which leaves us with a pretty profound, maybe even unsettling reality to grapple with. We started this deep dive talking about trusting the dashboard of a car, right? About relying on the instruments to tell us the truth about the engine. But we've discovered the dashboard isn't actually wired to the engine anymore. It's wired to the weather outside, to the mood of a million algorithmic day traders, and to the panic of hedge funds half a world away. So I want to leave you with a lingering thought to ponder the next time you see headlines screaming about the collapse or surge of a global currency. As we move rapidly into this new era of multipolar digital currencies, an era where capital can cross sovereign borders instantaneously at the speed of light, driven by algorithms and blind momentum, will a sovereign country ever truly be able to control the value of its own money again? Or will the sheer, overwhelming mechanical force of global capital flows eventually override national economic sovereignty completely?